Good afternoon and welcome to BizTech's Asian Midday Market Watch, powered by the Smart Investor Singapore. It's Tuesday, the 25th of October, and we have our new guest, James Whelan, Investment Manager and Head of the VFSS Group Global Macro Fund, coming to us out of Sydney. Now, welcome to the show, James.
Brian, it's good to be here. Thanks a lot. Just a very hot Sydney afternoon where I am, and keen to have a chat.
Now, James, before we get your insights, I'm going to take a look at crypto markets first, and then we're going to see how regional stock markets have performed. Now, we've got Bitcoin, which is at 19,047. It's down 0.66%. Ethereum is at 1,286.52. It's down 0.3%. Now, looking across to regional stock markets, we're going to start with the Straits Times Index, and that is up 0.61%. The KLCI out of Malaysia is up 0.1%. Shanghai is up 0.65%. The ASX All Ordinaries is down 0.25%. The Nikkei is up 1.11%. The Hang Seng is up 0.7%. And rounding up the numbers, we've got the Kospi, which is up 0.19%. Now, James, what's your view on the all green markets across the region right now?
All green markets, that's right. I thought that there was a slip from you there with the ASX saying that it was down 0.25%. It could have gone either way depending on the exact minute of the day that we say this. It was off. It seems to be sort of holding around that area now. So locally, my market that I know a little bit better seems to have rebounded and recovered somewhat. Mainly, it looks like it's being held up by the banks here locally, some of the biggest names in the market. Some of the miners holding it back, BHP and Rio not doing as well as potentially they did yesterday in that. Looking to China, it looks like China, and here's the biggest news that I could give you out of China is that it has not continued that disintegration, I think is the best word that I could use for it, that we saw yesterday. That's really important. We did see what was potentially some forced liquidity, some forced liquidation, not liquidity, but forced liquidation out of some pretty substantial Chinese holders in stocks. And also then overnight in the US, we saw that matched with the US listings of Chinese stocks getting absolutely smashed as well. Alibaba, and we've seen a Tencent copped it as well, and all those names that we know and love over in the US. That was beaten up yesterday night with some of those US listed Chinese indexes coming off about 20%. That's a pretty big day. There's a few reasons for that, and this is sort of where the market is looking now to see if we've got some guidance for exactly where the next couple of weeks, probably days, weeks, and months are going to take us. It's quite a crucial period following the 20th People's Congress that we just saw out of China, and the elevation of some members into Xi's inner circle, and the de-escalation of or the demotion of a few of the market, probably some of those market-friendly names that the people might have thought were good to have near presidency. Now we don't see them anymore. So this is sort of where the market is seeing this. One, not as market-friendly out of China, which sort of does hold back a lot of ambitions for what US corporations and global corporations were going to do in China. Also, the other thing that holds it back is that as it moves to being more of a Z's men only with a few less checks and balances, I don't want to use the big words that some people are using with regards to China, but if there seems like there's sort of a more totalitarian control or a bit more centralized control in the Chinese government in the direction, it sort of makes China a little bit less investable, which I think was what a lot of price action last night was showing us in China. What we're potentially now about to see out of China, especially where the markets are concerned, is that if we've got such huge short interest, and short interest has definitely grown in China, if we've got such huge short interest and such a that the bearish selling potentially is exhausted, what we could see is that Chinese state-sponsored buying of their own listed securities could cause quite a significant short squeeze. And the only hope that a lot of people have got potentially, if this is their last chance to get out, if they need to get out, could be on the short squeeze. So there's just that bit of the volatility that's coming out of China right now. Right now, there's too many known unknowns with regards to Chinese actions moving forward, especially with regards to an ending of the COVID zero policy. That's still up in the air. People are saying that potentially the new premier, with the fact that he was a full shutdown sponsor on Shanghai, maybe didn't get that right either. Maybe that means that COVID zero is going to be here to stay for a while. That's the big question mark that hangs over China at the moment, regardless of their GDP numbers that were postponed and came out yesterday. There's a lot going on, Brian. I'm sorry to talk all at once.
No. And you brought up quite a number of interesting points that we need to keep in mind, particularly the potential of the short squeeze. But I want to ask you now about bond markets, because yields have been spiking higher because of concerns around strong inflation and also hawkish monetary policy that everyone thinks will further slow the global economy. What are your thoughts on this?
The thoughts on it right now is that for the extraordinarily short term, while there is a Fed blackout ongoing, and we've also seen some slightly sluggish US data. Those PMIs have actually dipped into the below 50, showing a contraction number for their manufacturing PMIs. We've seen that maybe there could be this continued talk of a Fed pivot. Even better so now is that while there is a blackout in the US, there's no chance for them to talk up or down that either direction. And the markets are seeing that not such a bad earnings quarterly responses from companies over the last couple of days means that maybe there's a buying opportunity involved in that, and the market has responded in kind. However, I still believe that the Fed will have to continue doing what they're doing until inflation is at least halved. We still see 75 being factored in, maybe even another 50, and a continuation of talking up those rates in an upwards direction. What we are seeing, though, potentially is that there's a bit of a breakdown in the bonds market. It's not necessarily broken. It's just starting to sort of break down, and maybe you've got a the little red light that's in your car that tells you that might be something a bit wrong ahead, and potentially what we're going to see in the bond market is, again, there's nothing wrong with China doing state-sponsored buying, because if the Fed is about to go in and do some state-sponsored buying of their own bond market, that's pretty much similar. So we're seeing that the potential for that is also on the horizon. Nothing new. It's something that they did all the way through COVID. We are seeing that potentially they're going to be stabilizing their bond market with some buying, even more so than we've already seen. So that's what's ahead with that. Global rates will continue to go up. Locally, Australian rates will go up slightly more. We'll see that until at least February, potentially as being the last hike. Maybe that might be the first of the stabilization meetings before then coming off and going back down again. China, ironically speaking, lots of room to move with their rates as well. And they can continue to provide as much liquidity and stability with more of a dovish tone over in their side. So they're sort of on the other side of that slope right now. So more of a reason, not that I'm bullish on China at the moment, I'm happy to steer clear of it, but more of a reason potentially to have a good look at China if you need to have a good look at the stimulation and exactly what sort of growth can come out of there. But I hope that's given you a good overview of where I see the rates markets going. It's going to be higher for longer. Inflation is going to be here to stay, I believe, regardless of what we're going to see, until we start to see some real growth. And again, I come back to China, until we start to see some real growth out of China, providing a stabilization of prices, which have been going up, and Chinese GDP flooding the market with these amazing manufactured goods that kept us all in such low inflation for such a long time.
Now, James, thank you very much for your insights, and thanks for coming on the show.
No problem, Brian. Great to be here.
Now, we've been speaking to James Whelan, investment manager and head of the VFS Group Global Macro Fund, on BizTech's Asian Midday Market Watch, powered by the Smart Investor Singapore. This video will be on our website, www.biztech.asia, as well as our social media platforms. It will also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.